Hello traders, and a very warm welcome to our latest urgent market update video brought to you by the Live Trade Room. Now today is Monday the 8th of August 2022, and the focus of this market update video is around surprisingly big US jobs numbers there on Friday, but we're really focusing on kind of the market response and what opportunities that may lead to. So let's get straight into it then. We'll start, of course, with our risk warning. Just be broadly mindful of the risks involved in trading financial markets, and please take a brief moment to familiarize yourself with our risk warning currently up on screen. Okay, so let's get straight into it then. So let me take you firstly to Friday's non-farm payroll numbers. So if I just bring that up on screen for you, and we're looking at Friday the 5th of August, and if you scroll down at 1:30, we were expecting non-farm payroll numbers coming out from the US, along with the unemployment rate and the average hourly earnings. So we were expecting, I suppose, modest growth as far as jobs are concerned. We were expecting a number around 250,000 jobs to be added to the US economy, and what we actually saw was 528,000 jobs added. So you can clearly see it's pretty much twice what was expected. So a really, really positive number. Obviously, the more jobs there are in the economy and the more people get paid, the better that is for ultimately the economy. However, it's not as straightforward as it appears, because average hourly earnings coming in above expectation. We know we've got a very high inflation number in the US. Inflation currently over the last CPI numbers came in at the headline rate was 9.1%. So although people's earnings are increasing, they're not increasing as much as inflation. So it's eating away at people's cost of living. And the unemployment rate, lowered slightly from 3.6 to 3.5. So on the surface, broadly looks really quite positive for the US economy. Now, here's the downside. Here's the problem. We made it clear to our traders prior to that event that we wanted to keep a close eye on the bond markets. So if I bring up the 10-year, from Friday, we actually saw a sizable increase. So there's a bit of, I suppose, nervousness and anxiety creeping into the markets, because if we saw the indice markets extend to the upside, which is basically what we saw, and we're beginning to also see the inversion. So if we look at, so on the left-hand side, we've got the 10-year bond yields, which is at 2.79 currently, versus the 2-year treasury yield of 3.22. So actually, you're getting a higher yield on the 2-year than you are on the 10-year. And really, in normal market conditions, it should be the other way around. You should get a greater return for tying up your money for longer. But we've got this inversion, this bond market inversion, and it's increasing. So not only did we see an uptick in that, but we also saw the inversion begin to increase. So that lends itself to thoughts about recession and what impact that's likely to have. So that was the first thing we were looking at. Then what we were looking at was, okay, so under situations like that, with a higher jobs number, we would expect that to have a slightly we would expect the Fed to respond in a slightly more aggressive approach to interest rates, i.e. looking for interest rates to probably increase further, perhaps above expectation. And that's really what we're kind of focusing our attentions on. We know that the Fed are looking at unemployment very carefully, and if they've increased rates, they're desperately trying to get this 9.1% on the top left-hand corner there. We look at our sort of annual CPI numbers currently at 9.1. There was an expectation a few months ago that it was beginning to dip, and we saw further acceleration to the upside. So we know that the Fed are desperate to try and impact the demand side by increasing rates. But what it's led to is further demand, further jobs being created, and a fairly rosy picture. But this picture that's being painted is very much stagflation, which is ultimately not particularly good, where you see high inflation and limited growth. And We were already in a two-quarter recession in the US, a very technical recession. It's not something that's entrenched or deep. It's very, very shallow, but still we're currently in this technical contraction, GDP contraction currently, and the concerns are that this could get progressively worse, that rates could increase, and it could have this pretty shocking impact on demand destruction. So they're expecting a nice soft landing, increased rates, everything to tick along quite nicely, and inflation to start coming down. That would be ideal. The problem is if you're increasing rates and it increased the debt burden as well, and those of you that are paying mortgages will be paying higher fees with your mortgage provider. So the cost of living is going up, and we already know energy costs are going through the roof, and food inflation is going through the roof, and our basic cost of living is probably a significant number higher than the 9.1% that we're kind of been told for those of you in the US. So what we would expect, if we get a positive number, we'd expect the bond yields to start pushing higher. We'd expect that to put a bit more sort of short-term pressure on the Fed to increase rates perhaps more aggressively. We'd anticipate that to have a negative impact on the US indices. But taking the S&P, for example, as a good little case study, if we look here at Friday's, I'll just put a little box around it. So this here is Friday's price action. And what we saw, can I zoom in at all? Bear with me a second. Okay, so what we actually saw was the initial move very much in line with expectations, which is great. It's kind of what we'd want to see. We were looking for some selling opportunities as a result. But it created a low around the 4100, and it bounced off it pretty aggressively. Closing, it looked like a bearish spinning top candlestick. So then attention started to shift to today's price action, and we wanted to pause this video just to see how this market was going to respond, And as you can see, it's responded very, very aggressively, and we've technically made a new high in this market as well, just fairly recently, prior to making this video. So what we have is this inbuilt resilience in these markets currently. Okay, we are trading these markets in the month of August, which is not the best of months. It is lower volume and lower volatility in these markets as well. So quite tough market conditions to be trading in its own right. However, we do have strong levels of resistance just at these levels. So if we can zoom out a little bit and take a look at the S&P, somewhere around these monthly highs, we've got strong resistance. So we don't want to be necessarily at this point buying into that particular news event, especially when the market fundamentals would probably support perhaps a short-term little corrective move to the downside, but we're not seeing that. So this is why this move is quite interesting to start off with. We've been drifting sideways for 6 or 8 days, and now it's showing like we're looking quite positive. But the buy trade doesn't exist because we don't want to buy below resistance. We want to wait for that rollover trade to start to kick in, and for market fundamental sentiment and the technicals to stack up for us a little bit more so than what they're doing currently. So this is why we just wanted to draw your attention. And you can see the same bit of price action across the US indices. And as a result of indices, our expectation for the indices to roll over to the downside, we were expecting the dollar to strengthen. And as you can see, if we compare and contrast with something like the euro dollar, we're in this fairly significant long-term little sideways moving pattern there for the euro dollar, very much range bound. So Fridays, we saw that dollar strength creep in, and then we're getting this reversal. So this is why we're just looking at this price action, and okay, we've got CPI numbers coming out this week, which should really be quite interesting for these markets, and perhaps the limited response we've seen post non-farm payroll we might see with these inflation numbers. So it is important to keep an eye on some of these things if you're trying to capitalize on these market directions. But we did want to draw your attention to the fact that, you know, this is This is kind of counterintuitive price action, in our opinion, with our analysis. And like we say, we want to get market fundamentals, risk sentiment, and technicals all in some form of alignment, and that's clearly not the case. We are quite bearish on the market fundamentals. We are quite bearish on the risk sentiment, although we're getting technical positive price action. So that's why we've got a bit of a question mark hanging over these particular markets. And that's why we wanted to just draw attention to this odd market response, because we are certainly going to bide our time as far as looking for these selling opportunities to kick in. When that will happen is going to be an interesting question. We'd probably anticipate in September, as opposed to between now and the end of the month. It looks like we're building up a little bit of resilience, inbuilt resilience. But when these markets start to turn, if the US bond yields, if they maintain that inversion, if they're sort of looking a bit more bullish with regards to the bond yields, and these markets start to turn over to the downside, we would hope to look for some fairly decent bearish selling opportunities across the US indices, and we would expect the dollar to strengthen once more. Great stuff. So listen, on that note, guys, we'll wrap it up there. We just wanted to try and identify and try and put together the market fundamentals along with the technicals, just to present our outlook on these markets, and a bit of a question mark currently over the current direction of these markets. So do bear that in mind. Of course, you may have questions as a result of this video, so do feel free to email us at the support at thelivetraderoom.com, currently up on screen. If you do have any questions, we're happy to answer them for you. And of course, for more information, just go to thelivetraderoom.com about the products and services we offer traders. Those of you that are new and relatively inexperienced and want to get a truly solid foothold in terms of trading these markets, then of course we can help you there, and just go to our website. So on that note, thank you very much for joining us. Stay tuned for our next video, and we look forward to seeing you next time. For everyone here at the Live Trade Room, bye for now.